Benefit of long-term investment. A long-term investment strategy entails holding investments for more than a full year. This strategy includes holding assets like bonds, stocks, exchange-traded funds, ETFs, mutual funds, and more. Through investment in quality stocks, purchased at their undervalued prices, ahead of a potential growth of the company, industry and economy, long-term investors generate wealth for themselves. Individuals who take a long-term approach require discipline and patience because investors must be able to take on a certain amount of risk while they wait for higher rewards down the road. This offers a number of advantages that investors who try to time the market, or day trade over the short term, simply can't take advantage of. Here are 6 reasons long-term investing is undeniably the smartest and easiest path to hitting your retirement number. Before we start, please subscribe to our YouTube channel and hit the notification bell icon to never miss important updates like this one. Let's look at some important benefits of stock market investments. Number 1. Lower tax rates. When you invest your money in the stock markets for a short time duration, the taxes applicable on the gains to generate through these investments is taxed at a higher price level than the taxes applicable on long-term capital gains. Here short-term means any stock holding which is sold within 1 year of purchase, and long-term means gains accrued from stocks sold after 1 year of purchase. In India, STCG is taxed at 15%, whereas LTCG is taxed at 10%, hence, making long-term investment more tax beneficial than short-term capital gains. Number 2. Less costly. Keeping your stocks in your portfolio longer is more cost-effective than regular buying and selling because the longer you hold your investments, the fewer the transaction fees you have to pay. How much you pay depends on the type of account you have and the investment firm that handles your portfolio. For instance, you may be charged a commission or markup, where the former is deducted when you buy and sell through a broker, while markups are charged when the sale is directed through their own inventory. These costs are charged to your account whenever you trade stocks. Number 3. Compounding in dividend stocks. Dividends are basically corporate profits distributed by companies with a track record of success. These tend to be blue chips or defensive stocks. Defensive stocks are companies that do well regardless of how the economy performs or when the stock market drops. These companies pay regular dividends every quarter to eligible shareholders, which means that you get to share in their success. While it may be tempting to cash them out, there's a very good reason why you should reinvest the dividends into the companies that actually pay them. This means that any interest or dividend that your stock portfolio accumulates compounds over time, thereby increasing the amount of your account in the long run. Number 4. Potential to get exponential return. Investing in stock market for a long term has the possibility of earning you exponential gains as stock prices are highly volatile and sentiment driven. A good organization which has a lot of things going in its favor and has strong fundamentals can see its stock prices increasing multifold in a short span of time and can become a unicorn stock in the market. If you invest your money in such unicorns, then surely, there are chances of earning exponential growth over time. Number 5. You'll sleep better at night. My personal favorite is that being a long-term investor will allow you to sleep better at night. You won't have to wake up at the opening bell every day and decipher if your portfolio took a dive or exploded overnight. Chances are, the businesses you're looking to invest in are high-quality companies, and thus their propensity to be volatile will be relatively low. Finding dividend-paying stocks that other long-term income investors are seeking out is typically a good way to keep your portfolio volatility low and your stress level at a minimum. Number 6. It's really easy for anyone to do. One of the greatest aspects of long-term investing is that anyone can do it. It doesn't take a Warren Buffett to pick out a portfolio of well-run businesses and hang on to them for 10, 20, or 50 years. Sure, you're not always going to be right, but don't worry, even the greatest investors are wrong a third of the time or more. But with long-term investing there are no hassles about learning different trading styles or platforms since you won't be an active trader. In conclusion, investors who have more experience and a higher amount of capital at their disposal may be able to ride the market waves and make money using short-term trading techniques. But that may not work for those who are just starting out or aren't able to tolerate too much risk. Holding stocks for the long term can help you ride the highs and lows of the market. That will be all for today. Please like and comment. Thanks for watching.